Image of the American economy. It's viewed as an unstoppable engine of massive salaries and endless wealth. You see the markers of this lifestyle everywhere. It's the culture of the constant premium upgrade cycle, something that kicked into high gear years ago with the original $499 iPhone. To maintain this appearance of widespread prosperity, you need mass societal participation. It requires millions of people continuously spending on weekend shopping trips and the newest tech. But when you look closely at the data, a stark contradiction emerges. Millions of these same people, earning high incomes, are secretly surviving from one paycheck to the next. Their monthly earnings are exceptionally high, yet their actual retained savings hover near zero. The visible luxury is largely a facade covering deep financial vulnerability. It leaves us with a central question: why doesn't immense income actually equal wealth? This scale illustrates lifestyle creep. You earn a higher salary, but baseline expenses immediately rise to match it, keeping net progress at zero. You get a promotion, you sign a bigger lease. A year-end bonus becomes a luxury car upgrade. You end up trapped on a financial hamster wheel. You are working harder and earning more, just to fund a strictly more expensive baseline existence. The standard financial path operates as a perfectly engineered trap, designed to capture your new income before it can ever accumulate into wealth. The primary financial instrument enabling the solution is the universally accessible credit card. It's a system deeply entrenched in modern society. A credit card swipe relies on a very specific psychological trap. It allows you to consume products today by spending money you haven't actually earned yet. The trap springs the moment the monthly bill arrives, and you fail to pay the full balance. This line chart shows exactly what happens next. A small, flat initial debt balance suddenly curves aggressively upward into exponential growth the moment a 20% compounding interest rate is applied. The math translates to a harsh reality. When you carry that balance, you are no longer buying consumer products. You are selling your future labor to banking institutions. High-interest leverage acts as a hidden mechanism. It keeps the middle class financially anchored, regardless of how high their annual salary climbs. The wealthy operate under an entirely different framework. They largely ignore salary accumulation and focus strictly on asset creation. Instead of buying depreciating goods, they park their capital in specific vehicles: stocks, real estate, exchange-traded funds, and private businesses. The core philosophy is simple. Money is a tool that must be deployed to manufacture more money, not simply to purchase lifestyle upgrades. This split bar chart compares two strategies over 30 years. On the left is $500 saved as static cash. On the right is that same $500 invested monthly into an S&P 500 index fund, showing the massive exponential final bar generated by compound interest. Because true wealth is generated through long-term asset compounding, the wealthy remain relatively immune to the panic of short-term market crashes. Their wealth is tied to time in the market, not a biweekly paycheck. This widespread financial failure stems from a total absence of institutional financial education. Traditional schools actively ignore critical life-or-death financial concepts. They simply do not teach students how to navigate taxes, handle investing, manage credit scores, or protect against inflation. Instead, the curriculum is optimized for a different outcome. It trains people to be compliant employees who remain entirely dependent on a salary. This systemic financial ignorance guarantees a specific result. Even highly educated, high-earning individuals will struggle financially because they don't know how capital actually works. Ultimately, the gap between economic classes is dictated by daily financial habits, not income levels. The definitive poor mindset operates on a specific rule: spend your income immediately on lifestyle and attempt to save whatever scraps are left over. These two side-by-side flowcharts illustrate the contrast. The wealthy operate on the exact opposite rule. They invest their income immediately into assets and only spend what is left over. Stop prioritizing the purchase of liabilities just to look rich. Start acquiring cash flow generating assets so you can actually be rich. Financial knowledge is your ultimate currency. If you want to master these real wealth creation strategies, subscribe to the channel, and we'll see you in the next video.